So you've just settled a case over a false lien on your property. You might think it's all over, right? Well, when it comes to taxes, it's really just the beginning. We're about to do a deep dive into the tax treatment of what's called slander of title damages, and we're going to look at everything: the core legal doctrines, the specific IRS codes, and the strategies that every practitioner needs to know. All right, here's how we're going to break this all down. First, we'll start with the foundational legal doctrines. These are the rules of the road. Then we'll get specific and define slander of title because it's a pretty unique kind of property tort. After that, we'll dissect a settlement payment piece by piece, look at the mechanics of basis and legal fees, tackle the dreaded IRS 1099 forms, and finally, wrap it all up with some real practical strategies.
Okay, before we can even think about analyzing a settlement agreement, we have to get a handle on two bedrock principles that the IRS and the courts live by. You can think of these as the fundamental rules of the game.
First up, and this one is absolutely critical, is the origin of the claim doctrine. Thanks to big cases like United States v. Gilmore, we know we have to look past the settlement itself and go back to the original lawsuit. What was the fight really about? Were you trying to replace lost income, like rent, or were you trying to get compensation for actual damage to the property's value? The answer to that question changes everything. And this one question from the famous Raytheon case just cuts through all the noise. In lieu of what were the damages awarded? Every single dollar from a settlement has to be viewed through this lens. What is this money replacing? We're going to come back to this question again and again. It's that important. Now, our second key principle is the Return of Capital Doctrine. This comes from Internal Revenue Code sections 1001 and 1016. Basically, if you get paid because your property was damaged, the IRS doesn't see that as income in the traditional sense. Instead, it's seen as you just getting your original investment, your basis, back. It's only when you get more than your basis back that you have a taxable gain. Okay, so let's take those two big ideas and apply them directly to our main topic, slander of title. To get the tax treatment right, we have to understand exactly what this legal claim is. And this is a huge point. We need to understand why it's completely different from a personal injury claim. This is where the rubber meets the road. Personal defamation, that's like libel or slander, it's an attack on you as a person, your reputation. But slander of title, that's a purely economic attack on your property's wallet, its value, and its marketability. The court in Romer versus Commissioner made this distinction crystal clear, which really cemented its status as a property tort. And this whole distinction got put under a microscope back in 1996 when Congress changed IRC Section 104A2. They added one tiny but game-changing word: physical. From that point on, for damages to be excluded from your income, they have to come from personal physical injuries or physical sickness. Since slander of title is about economic damage to property, any argument for excluding it on personal injury grounds just went right out the window. All right, with that background in place, we can finally start tearing apart a settlement payment. You see, the IRS doesn't just look at a lump sum check and call it a day. Oh no, they get out their scalpel and dissect it, applying that in lieu of what test to every single part. Let's start with the easy one, punitive damages. The Supreme Court's decision in Glenshaw Glass is the final word here. Punitive damages aren't about making you whole. They're about punishing the other guy. The court basically called it a windfall, a complete bonus. And guess what? Windfalls are always taxed as ordinary income. No getting around it. Okay, this table really is your cheat sheet for this whole thing. If the money is for the drop in your property's value, the diminution in value, that's your return of capital, not taxed right now. But if it's for lost rent or profits, bam, ordinary income. Same goes for punitive damages and any interest paid on the award, which the Kovacs case confirms is just taxable income, plain and simple. Okay, let's get into the nitty-gritty. We keep talking about return of capital, but what does that actually look like on paper, on a tax return? And how in the world do you account for those massive legal fees you had to pay to even get the money? Let's make this super simple with an example. Let's say your property's basis is $500,000 and you get a $100,000 settlement specifically for property damage. So what happens? In the current year, you report zero income from that. Instead, you just reduce your basis by that $100,000. Your new basis is now $400,000. You pay no tax on that money this year. The tax consequence only shows up way down the line when you eventually sell the property. But what happens if the numbers are flipped? Let's say your basis was only $50,000, but you still got that $100,000 settlement. Well, you'd reduce your basis down to zero, and that extra $50,000, that's recognized immediately as a taxable capital gain. Why? Because you've essentially gotten back more money than you ever put in. That extra bit is a gain, and you've got to pay tax on it right away. Now, this next point is huge, and a lot of people get it wrong. According to IRC Section 263 and the Woodward case, any legal fees you pay to get rid of a false lien are considered costs to defend or perfect title. And what does that mean? It means you don't get to deduct those legal fees from your income this year. Instead, you capitalize them, which is just a fancy way of saying you add them to your property's basis. This actually helps you by increasing your basis, making it less likely you'll have a taxable gain. All right, let's switch gears and talk about the inevitable paperwork. Even if your settlement is totally non-taxable, I can almost guarantee the other side is going to send a Form 1099 to the IRS. And if you don't handle it just right on your tax return, you're practically begging for an audit letter. And here's a classic mix-up. You might think, oh, it's real estate, so it must be a 1099-S. Nope. Removing a lien isn't a sale or exchange, so what you're going to get is a Form 1099 MESC. The payer will probably report the whole settlement in Box 3 as other income, even if it's not taxable. They just do it to cover themselves. And there is another fun little rule to remember, the gross proceeds rule from IRC Section 6045F. If that settlement check is made out to your lawyer or their firm, the payer is required to issue a 1099 not just to you, but also to your attorney for the full gross amount. That'll show up in Box 10 of their 1099 MISC. And if you're thinking, well, I only got my portion, not the lawyer's fee, so that's all I have to report, think again. The Supreme Court in Commissioner v. Banks already shut that down. You have to report the entire amount on your return, the full 100%. Then you account for your legal fees separately by adding them to your basis, just like we talked about. Okay, so we've waded through a ton of technical stuff. How do we pull this all together into a real-world, actionable strategy? For lawyers and tax advisors, the tax planning can't be an afterthought. It has to start the second a client with a false lien case walks in the door. Look, the big takeaway is you have to play offense, not defense. First, when you're drafting the lawsuit, use the magic words diminution in value, damage to capital. Second, when you settle, make sure the agreement spells out exactly what each dollar is for. A vague lump sum agreement is an open invitation for an IRS challenge. Third, on the tax return, you show the income from the 1099, but then you immediately subtract it out on another line, clearly labeling it non-taxable return of capital. And finally, keep meticulous records of that new adjusted basis. And that really leaves us with one final and maybe the most important question you should be asking yourself. In the world of tax, documentation is everything. A well-drafted settlement agreement, one that's built on these principles we've discussed, isn't just a legal document, it's your shield. It's your number one defense when the IRS inevitably comes knocking.